second, guys. Get my drinks ready. How is everybody this morning? Can you guys hear me? Hey guys, can you hear me this morning? How am I sounding? Check my OBS, make sure the sound is going through. It looks like the sound's going through fine. Hope you guys can hear me. And next week we'll have some new videos so you're not just watching my ghillie trip. Good morning, Chester. Thank you for the feedback. For those that don't know, I live in Bali, Indonesia. Just got back from a trip from Ghillie Tea this previous weekend. This is the videos from that. All right, cool. Let's jump into it, shall we? By the way, today's music is brought to you by Arabisher Sprawl, who put together this list of Creative Commons synthwave music. I like synthwave. It's a lot of fun to... A lot of fun to study to and stuff like that. All right, anyway, let's get going. So normally we start off with talking about the wheel, how to do the wheel. Lately we've had very regular people showing up to the stream, so we've been skipping the wheel to give you guys more information. Let me know in the chat room if you prefer that I go over the wheel or not. Let me know if I need to turn down the music, if I need to turn the music down, or if the music to mic is a proper level for you guys. All right, I'm going to quickly go through the wheel strategy today, just in case anybody new is watching. We're going to go super quick unless anybody asks me to slow down. If you ask me to slow down, we'll slow down and do it proper. But otherwise, we're going to breeze right through this. So the wheel strategy, super simple. Once you learn options, this is one of the simplest option strategies you can use. And yet, I still consider it one of the safest and most effective. I've been using it for almost a year now. I don't want to say over, it's almost a year now. And you start by writing the cash covered put. If it gets assigned, then you write a stock covered call. If that gets exercised, you write a cash covered put. This is why I call it a wheel. It's just boom, 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 boom. But if you're doing it the way I'm doing it, 70, 80, 90% of the time each month, it will not get assigned to you. And then you collect the premium. You collect the profit on the premium because you're selling the cash covered put. You're not buying a put. See, when you buy an option, you got to pay. When you sell, you're going to get the premium. Okay? Then once you get the stock, you're doing the same thing. You're selling to collect premium. And if you do it, you can, there's actually a lot of ways to do the stock covered call. Writing the cash covered put, I've got a pretty straightforward method for that. But when they do the stock covered call, there's a lot more nuance whether you want to get more premium, whether you want to get more appreciation, and whether or not you want to hold the shares and for how long. But you can set this up so that 70, 80, 90% of the time you're getting premium, or you could set it up that you're getting the shares taken away so you get back to cash and get back to selling covered puts. There's a lot more, not just, it's not flexibility, but there's a lot more decision making, I think, with the cash covered calls. Anyway, so the wheel is not a spread, it is a tool, it is a management strategy, and it does not work on trash companies. Again, the wheel is not a spread. It's not like an iron condor or all those other things that you hear about. It's a simple two-step process, okay? It's important to understand the wheel is a strategy. It must be followed to be successful. Like all strategies, strategies fail when you break the rules or skip ahead. How do you fail at the wheel? I've just got these guys up here because they were ragging on the wheel, which is fine. But I feel like no matter how good you are at trading, if you rag on another strategy that you don't fully understand, you expose your naivete, okay? So how do you fail with the wheel? Number one, you're lazy and you skip the fundamental research. That's why a lot of people don't like the wheel. They don't want to do the fundamental research. Number two is your greed. You prioritize good setups, meaning high premium, high volatility, over good companies. You got to have both, okay? Fear, you manage too soon. We'll talk about in a second. Greed, your position size is too large for the account. And number 5, lazy again. You take too much sector risk. I've been guilty of this. I tend to trade in only a few sectors. I need to expand that. So how do you succeed with the wheel? Number 1 is patience. You have to do the fundamental research. It takes time. Number 2, balance. Prioritize good setups on good companies. Not just good setups, not just good companies. You need it combined. Number 3, you need the trust in the system and you need to manage properly. Don't manage too soon, don't manage too late. Number 4, discipline. Position size fits the account size. And number 5, balance. Select more companies in different sectors. That's what I'm trying to get better at. Okay, let's compare it. I don't like day trading. I'm going to be very clear. If you're a day trading fan, this channel is here to enlighten you as to why you might want to reconsider, because day trading is a job. It is a day job that you are paying for. You're paying to have a job. If you read the Cash Flow Quadrant by Robert Kiyosaki, it's a fantastic book. The E stands for employee, the S stands for self-employed or small business, the B stands for big business, and the I stands for investor. Everyone thinks they're investing in stocks, but if you're stuck in front of a computer every day, congratulations, you've moved yourself from the I quadrant to the S quadrant, which to me stands for slavery and what we're trying to get away from. So let's get clear. Investing is different than working. When we invest, we leverage our money to free up our time and give us more money. So it's about freedom. It's about freedom and money. Okay? When you're a day trader, you're sitting in front of your computer 8 to 12 hours a day. When you're not trading, you're not making money. That is the opposite of investing. You're a slave to the screen, you're a slave to the market, and you're not making money unless you're there. That is literally the opposite of investing. You bought yourself a job. When you day trade, you commit full time to risking your money to make more money. Not great. This is why day trading is just a risky day job and should be avoided. Day trading is simply worse than pursuing a high-paying job or starting your own company. If you're going to work full-time, either have a huge benefit at the end of it, like starting a company, or risk somebody else's money. Risk the boss's money. Don't risk your own money. So why do we wheel? Why is wheeling different than day trading? Number 1, it's convenient. You can do it from anywhere in the world. Number 2, it's a low time commitment. You can make it 1 hour a day or 1 hour a week, okay? Number 3, it's repeatable. You can find good setups every week, and when you find a good company, you can wheel the same company over and over again. If you like what I'm telling you, please hit the like and subscribe button. I'll answer your question in a second, Chester. Number 4, it gives you compound growth. 2 to 5% a month yields, when compounded, is amazing returns. You can go all the way down to 1 or 2% and use the wheel strategy. You can go up to 5% and use the strategy. I find it very hard to find good companies giving out more than 5% on the wheel strategy. I don't do it. Number 5, downside protection. What does this mean? When we sell our puts, we calculate the put and the premium distance, and we make sure that we're getting 10, 20, 25% downside protection. This means that even if the market, the whole sector, the whole market, or just your stock drops down 10, 15, 20%, you are still safe and covered. Number 6, safe. Limit our trades to good companies. Number 7, all right, let's go back to number 6. When you day trade, you just care about volatility and setups. You don't care if it's a pump and dump. You don't care if it's a New Jersey deli that's a money shell company, right? You don't care. You're in and you're out. When we wheel, we have the safety and security by being involved in good companies. Number 7, high probability. Literally every trade I'm making is north of 60% probability of profit. Most of the time it's 70 to 80% probability of profit. I will go a little bit lower sometimes, and that probability of profit does not include your fundamental analysis. Fundamental analysis makes it even better. Now to the question. Chester Wilson asks, why don't you write a call and make a strangle if you have extra cash in your account? Why don't you write a call and make a strangle? First off, I don't know why you would do a strangle. I think what you're saying is, why not do a credit call put? Excuse me. You can do what's called a credit spread. You can do a credit spread on the call side. You can do a credit call on the put side, which means you're buying a farther out of the money call or put to protect you from any big downside. Is that what you're asking, Chester? Just want to clarify. Now sometimes we can do that, or we want to do that on a cash covered put. If it's an expensive stock, it frees up your buying power. This is how people trade SPY, for example, on an index. The problem with doing this on a covered put is that it actually takes away your ability to own the shares. And owning the shares is not a bad thing. Let me know if I answered your question or not, Chester. I might have misconstrued it. Okay, Chester says on the call side. So, he's asking, why don't you write a call? So first you'd have to buy the stock, then you write a call, and then you could put a strangle on it if you have the extra cash in your account. Well, first off, you have to pay for that strangle. Number two, the strangles tend to be far outside the money on both sides of it, so you're decreasing your premium. And then what is the upside? The upside, I guess, is that you have downside protection if the call goes too far south. Not sure what the upside protection is here, in case the shares get taken away from you. It's an interesting concept. I wonder how often the numbers work out that you can do a profitable strangle while also doing a call, a covered call. I'll have to look into that. So the answer, I guess, is today, I don't know, other than I think it's going to lower your premium so much that maybe it's not worth doing it, and that you're not getting as much protection as you might think you are. Usually you have to be farther outside of the money to make it happen. Anyway, I'm going to continue on with talking about the wheel. Let me know if you have any more questions. Chester says, if you get assigned on the call, you get short shares. This is incorrect. The wheel strategy has no naked positions. We're writing a covered put, and we are writing a covered call. You will never get assigned shorting shares. You will not get assigned short shares. Guy Roderas says, my biggest losses to date were because of stupid covered calls. All right, moving on. Buying options versus writing options. When you buy an option, you are creating leverage on a call, or on the put side, you are creating insurance, or you're shorting the market. You're shorting the stock, okay? You're betting that it's going to go down. Buying options is high risk with medium to high returns. Medium on the put, high on the call. Also, time is against you. This is very important. I bolded it down below. Important, when you're buying an option, time is against you. So not only do you have to get the direction right, direction of the market, direction of the stock, direction of the company, you have to get the numbers right because it has to go enough in your direction, and you also have to get the time right. That is what we call a triple loser, if you ask me, okay? So what we like to do is we like to write the options. Why do we write the options? Low risk. These are all covered positions. Excuse me. They're all covered positions. The lowest a stock could go to is 0, just like if you're buying a stock. We are locking in medium returns. We do not open the trade unless we know that we're going to get a good fat medium return every month. You get monthly premium. Every time you do it, you lower your cost basis. That's what I talked about with the downside protection. And very, very important, I bold this. Time is on your side. You don't need a crystal ball. Can I make that any clearer? You can be wrong in a direction as long as you're not wrong too much, and you'll make money. You can be wrong in the time and you make money. It's such a better strategy, okay? I don't know why they don't teach this every time you talk about options. It should be the first thing you learn is the advantages of selling options, not buying options. So just to repeat, in the wheel strategy, we write a cash covered put. If we get assigned, then we own the shares. If we don't get assigned, we own more money. Isn't that beautiful? Now I said you own shares. If this doesn't sound good to you, you're doing the wheel wrong. You want to do this on companies that you want to own or that you don't mind owning. Now you own the shares. You can wait for it to go up. You can write a covered call. You earn premium on the covered call. You can set the covered call up correctly so that you get appreciation and premium. I'm going to skip the example today. I think most people in the chat room know what the wheel strategy is. If you have any more questions, let me know. Let's start talking about stocks in the market today. And I said at the beginning that we're going to talk about the triple income strategy. So I'm going to go look for a stock today. And if you guys have any recommendations, I'm looking for stocks today that have dividends coming up. Dividends coming up. So that we can, well, this is going to be too close, May 3rd, but I'm going to use this as our example today It's not going to be a very good example. Let's find some other stocks with earnings coming up. What are some of your favorite stocks with earnings? I had a list, but I left it in another window that I just moved and closed. So guys and guy, if you have a favorite stock that has dividends, I want to take a look at it today so that we could talk about the triple income strategy. If you give me a second here, I'm going to open up my list that I had ready, and we can use those. But if you guys have any, that would be fantastic as well. If I can find my list. Oh no, where is it? Oh, terrible, terrible, terrible. Oh. I found the list. Hold on just a second. Chester asks, is Microsoft too rich? Let's open up Microsoft just to take a look at it. MSFT. Boop, boop, boop. So Microsoft is a $249 stock, which you know, when you're doing options, when you're doing options, you're going to take 249, times it by 100, because that's how many shares you're going to do. That's a $25,000 buying power just for one contract. That's definitely too rich for my account size. I would wait till I have about a count of $250,000 that I'm ready to wheel for before I do Microsoft. So if you want to if you want to do options on Microsoft, if you want to get a similar thing, what you'd want to do is a put credit spread. Let me write it down for you in case you're watching. It would be a put credit spread. I'll type that into the chat room. When you get above comfortable size on the stock, on the price of the shares, then instead of wheeling, you might want to consider a put credit spread. I can't tell you what to do, but that's what I would do if I really wanted to be involved in that company. So I have a list of companies. I have not researched these companies until today. I did not pre-do this. We're doing this live together, okay? We're looking for companies that have dividends. I was about to say earnings. We're looking for companies that have dividends in the near future. It took away my spaces. Why? Oh my gosh. You guys are seeing this in the chat room, right? I'm typing out a bunch of different stock ticker symbols, and it's taking away the spaces. So I got to add, I guess, commas to this, because I've never seen a chat room do that before. YouTube is a crazy, crazy thing. All right, there we go. That time it stuck. So the first one I'm going to look at is T for AT&T. I know a little bit more about this company than the other ones. So let's take a look at it. It does not tell me the dividends date in Walmart. So let's go look in Yahoo. Dividends date was April 7th. I'm not sure. Okay. By the way, I just put this list together, but I got this list from somebody else. I have not researched this at all. So it's not going to be too surprising if some of these earnings date, sorry, I keep saying that, earnings date, dividend date, if these dividend dates are not lining up with this. Guy says he did INTC yesterday. I'm guessing you did, you sold the put because you're also doing the triple income strategy on this, or maybe you're just going to dump the shares if they get assigned to you on the call. Love to know what you're doing, Guy. I always love your recommendations and ideas. All right, so J&J is Johnson & Johnson. Big company, of course. Dividend is $4.04. I'm not sure if they're showing this as the quarterly or the annually. I believe Walmart shows it as the annually. So annually, this would be $4 per share, and we'll just double check it to be sure. We'll take 4 divided by 163.63, and that gives us a 2.4%, which is what it's showing here on Walmart. So now we know for sure that this is the annual dividend, not the quarterly dividend. So we're looking at $1.01, okay? Now, if you think about that, in a single quarter, that's not a lot, right? That's 60 basis points. 60 basis points per quarter. In other words, 0.6% for dividends. So let's just take a look at what we can do if we instead use the triple income strategy. So J&J, Johnson & Johnson is what we're looking at. And I'm looking at this live with you guys as well, okay? So it's not like I'm recommending these stocks. We're deciding right now together. May 24th is when you have to own the shares. May 24th. Let's make sure it falls on a weekday. So on a Monday. So you'd have to settle, I believe, and I could be wrong here, so you tell me if I'm completely wrong. I believe if it expires on the 21st, you will fully be assigned the shares in your account and settled. Settled is the word I'm looking for, by the 24th. So we can sell the 21st of May put. And Guy is right, these are expensive shares. But we're just going to use this as the example, although I don't think we're going to get too much out of this. All right. So you're only going to get 20, oh no, I'm looking at the wrong line. You get $1.59 at the money. It's trading at currently at 163.20. The closest at the money is 162.50. You get $1.59 on premium. Whoops. That equals 97 basis points. Not a huge return, but if you add that to the dividends, then you're at 1.5%. And I'm not excited about this, okay? But if for some reason you were huge on Johnson & Johnson, you thought that they were going to be great, you wanted to add this maybe to your IRA or portfolio anyway, you could continue looking at it. It doesn't meet my criteria for good setup. It's obviously a good company. It doesn't meet my requirement for a good setup, so we're going to skip it and move on. Guy said he did. Intel, INTC, obviously another good company, although we wouldn't want to skip our fundamental analysis completely. However, dividends are May 6th, so we don't have much time value on Intel. Now, a lot of people use this strategy. They do not mind doing it. They do not mind doing it expiring weekly. They don't mind doing weeklies on these, okay? So you're only going to get, you'd have to do it today, expiring today. You get 20 cents at the money, which is poo-poo. Whoops. 0.2 divided by 58. You get 34 basis points. Then maybe you own the shares. You would collect, you collect 1/4 of 2.32% divided by 4. You get another 58 basis points. Because there's just not enough time value on this one, guys. So, Guy, you said you did this yesterday. Did you do it expiring today? Let me know what you're doing. And then we're going to check out HAS for Hasbro, the owners of Magic the Gathering, which was their only profitable line, I forget, a couple years ago. It was so funny. They bought Wizards of the Coast, and then I think a couple years after it, it was their only profitable product line. Anyway. Dividend date is April 30th. It's already April 30th. I'm not sure you can even do this properly. If you sold a put today, it would expire today, but I'm not sure that you would get credited as the ex-dividend date if it doesn't settle until over the weekend. I'd love for somebody else to tell me how this works with settlement dates and ex-dividend dates, because I don't think you get settled the shares until Monday. Guy Rodera said he did the June monthly. Okay. So you're not really, okay, so you're doing INTC, but you're not doing the triple income strategy. You're not trying to own shares. Either take high premium or own shares before the dividend. All right. What was the other company we were going to look at? J&J we did. HAS we did. So the other one is Citigroup. We have an ex-dividend date, again, of today, which I'm not sure that works. $72 stock, so let's just take a look at it real quick. You'd only get 22 cents at the money on 73. You're in the basis points. Okay, let's take a look at O, although I don't think they have earnings coming out. Earnings are May 3rd. So let's just, for an example, let's go 3 months out and pretend that we're doing a really long put on these. Not the best example, but you know, it's what I got for you guys today, because we're talking mostly about the strategy, not about actually doing the trades. So we'll set this up so that we can do it in the future. Oh, there's not a 3-month expiration on O. Let's try C. 77, that gives us July 16th. So this should be just before their next earnings. So let's take a look at this. Not a super volatile stock, only 31% IV. You can collect the 320 on the 72.50. That gives you 4.5% at the money. And so if you like Citigroup and you want to be involved in Citigroup long term, you could, instead of buying shares today, you could sell a put for at the money for $3.20. This means that if you were assigned, if you would own shares at $69.30. You can just look at your max loss in not TD Ameritrade, in Tastyworks. All right, so you'd end up owning the shares at $69.30, or it would expire worthless, and you would collect 4.5% over 77 days. Now this is not as good, or not as high, I should say, as wheeling for high IV. But again, if you're wanting to run a dividend strategy and own dividend shares, then this might be more attractive to you for those reasons, okay? You have different strategies for different accounts. I just want to see what the APR on this would be. So 4.5% is what we said. If you did this every quarter, and you were going to get the same or similar numbers, just by selling the put, you'd have an annual return of 21.3% on a company like Citigroup. And every time that you were assigned the shares, you would then collect the dividend, and then you could turn around and sell the call. So let's pretend that this happened. You could sell the put for $3.20, you'd end up owning it for $69.50, you'd collect your dividends, so maybe your cost basis is about $68.50 or something. Let's just keep moving forward, okay? Then you could turn around and you could sell a call at the money for about $4. So now you'd get another $4, plus you keep your dividends, okay? And if the stock goes up, you'll get your shares taken away from you, but you get to keep that $4 in premium. If you can play with this. So instead of getting $4 at the money, maybe you go up a few strikes, decreases the chance of it getting taken away. You get to keep your dividend. You make $2 selling the call, and you repeat that until it gets called away. And if the price moves up in between time, like let's say it goes up $1 and your strike is $2 out of the money, well then you roll it up. You just sell another call. You can close that one early or keep it. And then you keep moving up the call strike price. You get what I'm saying? You don't have to keep selling the same strike price, if that makes sense to you guys. Hey guys, I hope this is being valuable for you guys. If it is, I got 9 of you in the chat room. I've only got 1 like on the board. Give me 3 more likes, guys. Just hit that like button. It doesn't cost you any money. Not yet. All right. So we're at 9 o'clock. We got 30 minutes before the bell. I've talked a little bit about the triple income strategy. We didn't have any amazing stocks to go look at that I would have done, but it is kind of interesting what you could do on some of these bigger stocks. Even with dividends coming out now, you could potentially sell 3 months out of the side. Hey, thank you guys for those 3 extra likes. We got 4 likes. That's 4 better than it was when we started. Okay, I do appreciate that, guys, and I'm trying to give you guys really good critical information here. Okay, so if you're afraid of wheeling for some reason, I don't know why you would be, but if you're afraid of wheeling, or you really depend on the income that you get from your stocks and you need that to live on month after month, maybe you consider doing this wheel strategy on these higher priced good company stocks that have dividends, and you choose a date where it expires before the dividend date so that you lock in those dividends. Then you collect the dividends while simultaneously you sell a covered call a month out, 2 months out, etc. All right? All right, now we're going to jump into our normal wheeling strategy. We're going to go look for some stocks today. And I tell you what, I opened up my settings on my scanner to see if we can find up any new companies today, companies that we don't normally look at. I actually have enough open positions. I have enough stocks that I don't need to do anything else really, but let's take a look and see what we can find. Norwegian Cruise Lines. Earnings come out May 12th. So that's not much time. We'd be doing a wheels through earnings. I don't normally like to do that. Currently trading at $30. They're on a high end of the trading range for a year, but they are still, what is this? Looks like 40, 50, 60% from their all-time highs. They were normally trading at, okay, basically 50%. They used to be trading at a $50 to $60 range. Today they're still trading at $30. Obviously they're not open for business yet. I was wheeling last year. I was wheeling Carnival Cruise Lines and made quite a decent profit from that. But when they didn't reopen for COVID anytime soon, I stopped wheeling them, which was interesting because then the price actually started going up. As people became more and more optimistic about the vaccine, yet their bank account, their cash on hand got worse and worse. Okay, so we're not seeing their cash on hand, which is interesting for Norwegian Cruise Lines. This line is completely blank. Not sure why that is on Wallmine. And they are based out of Miami, so I would expect this information to be more available. Let's check it out. NCLH on Yahoo. Actually, I already had it open here. Let's go to their financials. Go to the balance sheet. Whoops, clicked the wrong button. Go to the balance sheet. Let me know if the music's too loud. Let me know if the audio's okay. Feels like it's a little loud right now. I'm going to turn it down just a little bit. All right, cash. Working capital, 1.6. Total cap, net tangible, working capital, invested capital. Does not tell me, I usually use Wallmine. Wallmine is a little bit better, so it's not telling me the cash on hand. Anyway, they're losing $700 million a quarter. Their liabilities are 14 billion out of 18 billion. They're already at 77%, and they're still losing, quote, 7/10 of a billion every quarter. So I'm not going to trade this company. I don't think this company is going to crash and go bankrupt, but you know what? Why wheel something that could, you know? You don't want to take that type of risk. If you're going to do it, you do a strangle or something on it. You don't do a wheel on it. All right. Overstock, I haven't looked at that for a while. That one's still trading really high. They got a big boost from COVID. Carnival shows up in our scanner again. Let's take a look at that. Wallmine does this thing where if you search for something, it does the crypto first if they have the same symbol. Carnival Cruise Line. See, I got lucky. I bought here at $8. I wrote it and sold, I think, at like $17, $18, $19. But I was wheeling it all in here, this $14, $15 range. And then when it started going above 20, I stopped wheeling it. It also was going up in price while the financials looked worse to me, if you ask me. I wanted to hold some CCL because they used to have a fat dividend. And if you own shares at $8 a piece and then start getting $1, $2 a year, I'm sorry, $4, I think they used to have a really fat dividend. I don't want to get it wrong, but I think it was like 7, 8, 9, 10%, and it used to be trading at $40 a share. And if you suddenly owned it at $8 a share and got a similar dividend, it would go sky high. You'd be like sitting pretty on dividends. Anyway, so they're losing, geez, $2 billion a quarter. They have $9.6 billion in the bank account, so they're actually doing pretty good. I think they diluted shares or took on some debt since I looked at them. So 1.9 divided by 9.6. I did that backwards, 9.6, because most of the time we're doing it the other way around, 1.9. You got 5 quarters before this company needs to raise cash. They've got 37 billion in debt versus 57 in assets. They're at 65%, which is scary for me because once they get to 70, their banks don't want a loan on it. They want to just issue shares. All right, and how much of this is intangible? 2 billion is intangible, so I'd rather divide 37 into 55. And yep, you got 67%. So I don't want to do it. Price seems a little bit high. They haven't reopened. It's just not safe enough. If you wanted to do something on this, I think you'd use a different strategy. And we're just looking for wheels. We don't try and apply 10 different strategies to 10 different stocks. We're just looking at wheeling. Earnings date on GRWG is 13th of May. I already have one put waiting to expire on this one. Let's just take a look at it to see if anything's changed. Look at the news. GRWG, nation's largest chain of hydroponic and organic centers, announced it has signed a lease in Jackson, Mississippi for the future site of a state-of-the-art Grow Gen Garden Center as Mississippi's medical cannabis market begins to open up. And what I like about GRWG is they're not directly cannabis, so they're not directly regulated. They don't have to jump through all the hurdles that other companies do in the sector. And they go through market to market, buying up the biggest hydroponic stores in the state, and then suddenly they're the biggest player. So they're operating very, very smart. And look at this, their profit, this is a net profitable company every quarter except March 2020. They make 2.5 million, 3.3 million, 1.5 million. They're making money while expanding rapidly. This is why I'm interested in this company. Cash on hand is 177 million. Total assets is only 354 million. This to me, I mean, this is, what's their market cap? Market cap is 2.6 billion. Cannabis should be a $65 billion industry in 2025. They're already 2.6 out of 65 billion, but you know, that's 65 billion in revenue moving forward in the cannabis sector. And I think that's just the US. I'm not sure if that number is US and other Western countries or if it's just the US. But look at this liabilities, guys. 37 versus 354. They only have 10% debt on the books. I mean, think about this, guys. We were looking at companies that were 67% debt on the books versus 10%. This is a growing company. It's buying up its competitors. It's in a growing sector. Literally, that's like a double entendre, right? It's a growing sector. Get it? Cannabis is growing and it's growing. Anyway, hope you guys get that. I'm trying to make this funny, guys. Finance can be really boring. If you guys thought that was funny, give me a like. If I see one like on the board, we know the dad jokes and the double entendres are good. If you had, I gotta wait till earnings. Or maybe not. Anyway, I really like GRWG. I want to keep doing wheels on it. I think it's a really smart company and a really smart play to do wheels on GRWG. If you guys open up some wheels on GRWG and you make some money, make sure you visit our tip jar in the description below, because I do think this is a great company to make great money on it, and I want to continue to wheel it, and I don't mind if I own shares on this great company. 10% debt on the books, and they're expanding and buying up all their competitors. $354 million in assets. Although, wow, I just noticed 84 million of that is their quote-unquote intangible and goodwill. I don't think they own that many patents, so I think that's branding power. I'd have to take a look at this. And look at this jump. From September to December 2020, they jumped their intangibles from 22 to 84 million. I wonder if they did buy up some important patents or something, or technology in the grow sector, rather than just branding power. I'm not a big fan on the valuations for branding power. I don't fully trust it. And it's something that could dissipate overnight, you know? Something with good brand power could just suddenly not have good brand power anymore. So I don't like it when I see that in the financials. In other words, I don't like it to see it be a major part of their financials. Now, it does make sense in tech. When you're in tech and you have tons of patents on, you know, search engines or whatever, then it's fantastic. All right, Smile Direct Club, 10th of May. I looked at this company last year. They had some complaints with the Better Business Bureau, complaints for consumers, and they're a negative growth company. I mean, they're negative geared. They're a growing company. They're losing 30 million, 26 million, 12 million, and 10 million a quarter. But notice this is trending down a lot. So they're starting to become profitable. That's a really good sign, especially if that trend is set to continue. I'd like to listen in on an earnings call and find out more. Debt looks a little, yeah, that's not a little high. I was doing it. Yeah, guy says GRWG doesn't pay dividends. Yeah, at 9 o'clock I switched over from talking about our hot topic of the day, which was the triple income strategy, to just going back to do regular wheel strategies. I just wanted to make sure that we're teaching something new every time we do this. And so I did want to go look at a few triple income strategies, but we're moving on to companies that don't pay dividends now. All right, so Smile Direct has a ton of debt on the books. They do have $316 million in cash. They're spending $10 million a quarter. Well, they're spending between $10 and $30 million a quarter. So let's average it. Let's call it 20. Okay. Let's say they're doing $20 million a quarter. So we take 316, divide it by 316 divided by 20. You've got 15 quarters unless their debt starts to catch up with them. They've got 65% debt. If any of that ramps up or becomes due, then they might have a serious problem. Chester says, in yesterday's space video, you talked about buying the shares with the credit, like about 7 shares. Yep. That is true, Chester. Guy says he loves NVIDIA for put spreads. I know a lot of people love doing NVIDIA. NVIDIA. Oh, and they've got dividends coming out May 26th. We could sell a put expiring May 21st. But this is a very expensive stock to do as a wheel. Excuse me, big burp. To do as a wheel. I have to drink a lot while I'm doing this because talking so much dries out my throat, and then I start having these burps. Anyway, if you get close to at the money, you get a 3% return selling a 21-day put. That's almost, 3.5 if it was a 30-day put. So that's actually not too bad. But you're tying up $610 per share. That's a lot of money. That's a lot of dough. Right? That's a $60,000 put, which is why Guy does it as put spreads. So to do a put spread, I'm curious how far you'd go out of the money on this one. And it doesn't really fit our triple income strategy. But for example, maybe if you go $20 out of the money, you can sell the 18, buy at 10, you collect 8 in difference, 8 between the spreads. You'd have a max loss of 1,000 and a max profit of 800 as long as it stays. Let's take a look at the curve, by the way. Curve analysis. As long as it stays above basically 600, it was a 601, 602. As long as it stays above 602, you would collect your $800 in premium. So you have $8 of downside protection. Not a lot on a $610 stock, but let's take it. 602 divided by 610. You have a 1.3% downside protection, but your max loss is $1,000. Your max profit is $800. That does look like a pretty good put spread, except the downside protection is not very large. Not very large at all. But and I'm sure the guy has different numbers than the ones that I picked out. You could go, let's just go down to like the 11 and then buy the 5 and see what that looks like, because that'll give you better downside protection. Now, if you were to do that, then your downside protection brings you to about 589. And if we take 589 divided by 604, now you've got a 2.5% downside protection. You'd be making $680, but you'd be risking $1,800. So you're doing a 3-to-1 win-loss ratio reverse, a loss-win ratio, 3-to-1. But you collect $680 as long as it stays above 589. Now, I don't do put spreads like Guy does, so let me know what values and strikes you're looking at when you do them, Guy. Guy says, and he's already answering the question before, we've got a bit of a chat delay, by the way. So when you guys hear me, it's already a few seconds past, and then you guys type back to me, and I don't see it for a few seconds, because I am all the way in Bali. All right, he says he did the 555 and the 565 for the May 21st, so we're at the right expiration date. Whoops, clicking buttons. Let's clear this out. So, 565 we're selling, 555 we're buying. This gives us a max profit of 132, a max loss of 868. But this is why I like Guy's way of doing it. You have downside protection all the way until $563. So the share price would have to drop $60 basically before you were to lose any money. This is why I like Guy's recommendations. He's got some good action going on. All right, let's take a look at what that is. So what number did I say? We would be at 563. 563.50. Let's call it 563.50. 563.50 divided by 604.80, which is today's trading price. Now you're getting a 6.8, almost 7% downside protection, but it's a lot of dollars, right? There's probably a lot of people with buy orders in at every $5 and $10 mark, right? So as it hits the 600, people are buying $5.95, they're buying $5.90. It's a lot of support levels to break through before you would get taken out. But if we do look at the previous trading range, I don't like this, Guy. What did you think about this? They are in an uptrend, but their previous trading range was well below what we're selling the puts at, well below our break even. If we consider, even on the high side of this support line, you're considering a support line at about 555, and really the support line should be drawn right about 515. Let me know what you think. Anyway, Smile Direct, we're going to skip that and move on. CPRI Sportswear. Is that Capri? Michael Kors. I wonder why it's called CPR. It is Capri Holdings for Michael Kors. All right, earnings are 26th of May, $54 stock. This might be, sorry, that's earnings. Tonight I just want to keep mixing up dividends and earnings for some crazy reason. Wow. So they made, this is just interesting to me, they lost $500 million in COVID March, then they lost $180 million the next quarter, then they're positive 122 and 179. Their cash on hand is 229, so they literally had 50 million cash on hand, and then income brought them back up to 229. 7.7 billion, almost $8 billion in assets, but 5.4 billion in debt. Puts us right at 70% debt to asset. I'm gonna skip it. Don't like it. Okay, you can do it if you really like, if you really like the company, maybe you want to ignore that 70%. But my experience says just skip it. Why? There's 9,000 stocks you can do. Why touch a stock with 70%? Excuse me, geez, 70% debt ratio. Hey Chester, you mentioned yesterday's video. By the way, if you guys haven't checked it out, let's see if I can bring it up real quick. Yesterday I talked about how you can use selling puts to get free shares of space by using the premium to buy the shares. Okay, it's only a 4-minute video. I highly recommend that you go and check it out. It's already had 113 views. Only has 8 likes. Come on guys, 113 views. Go watch that video and give it some likes. It's help support this channel, keep it going. Most important thing you can do, help the algorithm with your likes and subscribes, of course, but probably more important at this stage is sharing it with your friends. Any friends that you know that want to invest, have talked about investing, might or should need to invest, they're reaching an adulthood age, send them a link to our videos. Chester Wilson says, why don't you buy shares on all the trades? You know what? If I had done that, Chester, if I had done that last year after COVID, I'd be a wealthy man. So it is actually a great idea that if you do the research, right? Because we talked about this, you're pairing good setups on good companies. If you do the research and you actually buy the shares and sell the puts, that is a fantastic way to go. And I wish I would have started doing that in, April, May, June, right? Especially May, June. If I had done that in May, June on everything that I was selling puts on and everything that I was doing options on, I'd be richer today. My only question is now, was that just a case of a bull run, or is that actually what we should do in the future? It's really it's really murky to try and think of back testing or hindsight on that strategy when you're dealing something like COVID, where everything dropped 50% and then came back up 50%. You know, they're not at their all-time highs, but they're halfway back up. So if you just bought, I mean, basically, if you just bought anything in April, May, June, you'd make money. The reason we do the wheel is for that downside protection. So if you buy, that's the problem for some companies. It's why I do like it on growth companies like space. You want to buy shares, that way you get that big upside. You're selling puts so that you get cheaper shares and some downside protection. But when you're buying the shares, you're decreasing your downside protection. So you just got to do it on the right companies. All right, what company were you looking at? GoPro. These guys had huge momentum and then lost it. They could have done a lot more with their company. Anyway, cash on hand is 327. They're profitable, 44 million every quarter. They're going up every quarter. Liabilities is super high. This is going to be ridiculously high. 555 divided by 771. It's not as high as I thought it was. That's a 72% debt ratio. But they are having huge revenue growth quarter over quarter. Earnings come out May 6th. Let's put this on the back burner and look at it after May 6th. So I'm just going to open up my calendar on another window and put a note to reevaluate this company May 7th. We have 7 minutes before the bell. We haven't found any trades I would do except GRWG and SPCE. Obviously, I put out the space video yesterday. I opened up a couple positions on that. I already have one position on GRWG. I might open up another one. Sorrento Therapeutics, Workhorse. What do we got? Workhorse recommendation from the scanner is currently trading at 1261. Recommending the $9 put. That gives you a 2.4% ROI in 35 days. Not very high. Only 25% APR. I wouldn't do that one. I'd ignore the scanner on that one. American Airlines, 21, excuse me, trading at 21, could sell to 19. 2% in 35 days, 2.5%. Space, SPCE, it's got a couple listings here. You could do the May 28th, 22. It's currently trading at 22.54. You could sell the $17 put, get 2.25% in 28 days. I think we did better yesterday. Oh, let's see. Come on. Well, it's loading. We'll keep going. Triple D. That's one of these companies I've been looking at. It's on an ARC. It's on some of the ARC ETFs. It's in a good sector. I don't know much about the company. This sometimes shows up in my scanner. It's one of those companies, you know, Chester was saying, why don't you buy shares? Triple D might be one of those companies where you want to both buy the shares and sell the puts. All right, so what company were we? We're going to come back to GoPro. So I'm just putting in a note in my calendar here to reevaluate GoPro on May 7th. Chester wants us to look at WDC. That's right, guys. If you want me to evaluate your stock picks, just type it into the chat. This is a live showing. We're very, very live doing this, so I'm always happy to look at you guys' stuff. Oh, Western Digital. You were talking about this in the in the Discord group. You like this one. Revenue quarter over quarter is down. They are net positive. I think we talked about this was kind of a boring company, right? For whatever reason I said that. We talked about this yesterday. If we go 28 days out, implied volatility is 53%. You could get basically $4 at the 71. You're getting 5.5%, so you're not going to get much outside of that. If we come down to $2, you're probably going to get, 2.5% in 28 days. You get 3% still. Let's come down to $1.50. $1.65. And this bid-ask spread gets a little crazy here. This one almost feels like, yeah, it feels like it's got too many strikes. It doesn't have enough open interest. Chicago board should eliminate these 50-cent strikes and make everything $1 on this and clear up that bid-ask spread that we're seeing. Oh, my music stopped. Give me my music. Do. All right. So 66, you can sell it. $1.65, you could probably get $1.80. $1.80 on 66 would be a 2.7% return. You collect $180. If you had to buy the shares, you'd be buying them at $64.19 a share. $64.19 divided by today's trading price of 74 gives you that 13% downside protection, 13.25 downside protection, aka discount. I mean, if I was doing it, this is the way I'd want to do it. And if unfortunately, there's not enough open interest that you can't buy too much downside protection. You know, the only problem with this is it's not a lot of premium. But otherwise, that's basically how I would set that up. TWAS. I think you were typing "it was," and I'm thinking TWAS is a ticker symbol. We got 2 minutes before the bell. Make sure you like and subscribe before you tune me out to go trade. Happens every time. And very importantly, guys, share this video with your friends. Tell them how great our channel is. That's what's going to make this channel bigger and keep it alive. All right, I was looking at Space and Triple D. My scanner was taking a while to load. 2.2 and 2.3%. Selling at the 17 and the 1650 put. I'll tell you what, the 1650 put on Space, I wheeled Space a lot this last year. 1650 is a very safe, attractive number if you were happy making 2.3% in 35 days. Triple D, you can get 2.25. Let's go back to, see, I have different scan settings that are pre-built into this. Oh, excuse me. Do, 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 do. 1 minute before the bell. If you haven't wheeled anything and you were looking for something that I might have done, I didn't do them today, it would be GRWG and SPCE today. Blink, Mara, Riot. Oh geez, Riot has a huge ROI. That's 49 days out. I might start wheeling Riot and Mara again, even though I have so much exposure to Bitcoin. What is OCGN? Ocugen, OCGN. I haven't seen this one before. Biotech Healthcare. Ocugen is a clinical stage biopharmaceutical. By the way, the bell is open. Good luck trading, guys. Ocugen, a clinical stage biopharmaceutical company focused on developing gene therapies to cure blindness diseases. Oculus Gen, okay. And the company's pipeline product includes OCU400, a novel gene therapy candidate restoring retinal integrity and function across a range of genetically diverse inherited retinal diseases, such as retinitis pigmentosa and liver congenital amaurosis. I'm not a doctor, guys. Excuse me if I say these things wrong. So, for a biotech company, we're looking at how many things do they have in the pipeline? 1, 2, 3. Looks like they have at least 3. Anyway, I don't plan on doing this one without a lot more research, so I'm going to skip it for now. But I might add that to my watch list. But let's take a look at, yeah, earnings are May 7th. So I'm going to add OCGN, although their implied volatility, their IV, is probably going to drop a lot after earnings and not be worth researching. But I'm going to put it in my notes to research that one later. So I'm adding that to my watch list for May 7th. Moving forward, GTT, I don't know what that is, never seen it before in my life. Gas Transport, it's a Euro company in the industrial conglomerate sector. Engineering company provides cryogenic membrane containment systems for the maritime transportation and storage of liquefied natural gas. So it's an energy play. I don't touch energy. We're gonna mark this one. Whoops. So I have this great system on my scanner where I can write notes about a company. It saves it, and I can color code it and then filter by color code so that I never have to look at it again if I don't want to. Isn't that beautiful? And so that is what we're going to do so that I never have to look at this again. Gas and oil energy. So I don't trade gas and oil, too much politics involved. Sage, S-A-G-E. Oh, All right, we got 7 viewers and 6 likes. One more like puts us at 7 and 7. That'd be a beautiful thing. Sage Therapeutics. I did see this company last year. Could have bought it at 28. Currently trading at 78. Would have been nice. Coulda, woulda, shoulda. Whoa, they went super profitable in December. They made $1 billion, and they have $1.6 billion in cash, 86 million liabilities to 2.1 billion in assets. Yeah, let's go ahead and take a look at this. I don't even care what they do. I was trying to make a funny joke, but I couldn't think of anything in biotech related for a funny joke. They could be selling fifth legs to dogs. I don't know. Terrible jokes. Come on, guys. Doing the best I can while trading. Sage Therapeutics, currently trading at 78. Earnings come out May 4th. There's no 90 days. You could do a 49-day, get $15 at the money at $77.50. They have so much cash on hand. I can't imagine that earnings would destroy this company. That's a 20% return in 49 days. What was the scanner recommending? I'm going blind here. There you go. Sage, currently trading at $78.88. It's doing the $50 put. That's crazy. For $4.80. That's a 10% return in 49 days. Let's see if there's any bad news on this, and let's see if the price is moving. Barely moving on the price. They have some big conference they're attending in May. They're doing their financials May 4th. Today is Friday, so if we didn't sell a put today, we couldn't sell a put till the 3rd. I'm tempted to just do one on this, even though I don't know that much about the company. But that cash on hand and that income is just insane. How can you hate this company unless it's just overvalued? But it doesn't look like it's that much overvalued. Actually looks like it came down from its all-time high. I mean, recent all-time high. Anything previous to COVID should just be called the pre-COVID all-time high or something. So it was already at 96. It did a double dip down. It looks like it's going stable now. Hey, Guy, you in the chat? Why don't you take a look at this one for me and tell me, just pretend that you're not wheeling it at all. Just pretend that you were looking at this stock chart and maybe you were thinking about doing a play on this. What would you do? Curious to see what you would do. S-A-G-E, if you're listening. S-A-G-E, Sage Therapeutics. They have earnings coming up on May 4th, but look at their cash on hand and income. They made like $1 billion in December. It's crazy. And their liabilities is nothing, it's pennies. The company made $1 billion in a quarter and their total liabilities are 86. Come on, just look at it. Not touching biotech point. They've got 86 million in liabilities, 2 billion in assets. That's got to be something in biotech. They treat central nervous system disorders. Its lead product candidate is Zelrusso, intravenous formulation of something for the treatment of postpartum depression in adults, so after birth. Includes a steroid for treating postpartum depression. So they treat depressions, epilepsy, Parkinson's. In their pipeline, they have 1, 2, 3 products. I'm going to take a flyer. I'm going to take a punt, not a flyer on this one. You could sell the $50. Well, you can't do it anymore. It's gone. June 18th, we could have done the $50 put for $4.80. That's been crushed down to $3.10. There is a crazy bid-ask spread. You still might get $4.80. I'm going to put it in just to see what happens. My share price would be 45, sorry, 40. Currently trading at 77.5. That is a massive 41% downside protection. Yeah, I'm going to do this one. If you guys are watching, I'm going to do the $50 put on Sage, and I'm going to try and go above bid to see if I get fill. I got filled right away at 460. It's almost a 10% return in 49 days. All right, so we put on one of those. I can research it. I don't know, that's pretty tempting. That downside protection on this is really, really sexy. I gotta think about this. Let me know in the chat room what you guys think about this. I mean, it's biotech, but the income is huge. The implied volatility is huge, 152%, and you're selling a $50 put on a $77, 79 now, $79 stock. There's just so much downside protection. This is insane. I mean, this is money. I actually got to write a friend real quick. Excuse me, I got to make sure he knows about this one. I think this is, I mean, guys, talk me out of it. Tell me why I shouldn't do it. This could be the next big thing, or it could be a dud. Sage. I'm telling my friend about this. The 49-day put at 50, filled at 460. Currently trading at 79.41. Ooh, I wish I would have known about this one yesterday. Wish I would have known about this one yesterday. That would have given me a whole extra day to do the research, or if I would have seen this one this morning, Bali time. It's a shame on me for not doing it sooner. All right, I'm going to try and open up another one, but I'm going to try and go much higher on the price. And then I have one I can close early if I want. By the way, it's another tip for you guys after a year of trading. I really like it. I really like having multiple contracts. I'd rather have two $20 contracts than one $40 contract, because having two contracts gives you the option of closing one early and letting the other one expire, or letting the other one ride. And if you've got 10, then you can do 4 or 6 or 5. You can do all these other crazy things, especially if you're really bullish on the company. Well, let's see what our positions are doing today. We got a mix of green and red today. Space, what is Space doing? Space is down 23 cents. Oh, come on, don't ask me for my password in the middle of trading. That's annoying. I don't know why Tastyworks does this. Sometimes you open up Tastyworks, it doesn't ask for your password, and then just randomly every half hour or something while trading, it asks for your password. Somebody tell Nick Sosnoff, that's super annoying. Just ask for it when I open it. Every other program in the world asks for the password when you open it. This is the only program where it doesn't sometimes. Anyway, AI is up 8 cents. Apps is up 2.7. Sorry, $2.70 if you followed me on that one. ArcG is going down. Chester says, try to tell them about bugs. I don't know what that's referring to. This isn't even a bug. It seems like it's a feature. Hey, wouldn't it be cool if you accidentally close the program, you could reopen it right away, and then 15 minutes after the bell opens, it asks for your password while you're in the middle of trading. Anyway, ArcG down 43 cents. I think I had a lot of downside protection on those. Yeah, I'm at the 83, the 81, and the 76, so we're good on that. Let's look at our in the monies first, yeah? That's smart. Tasty bugs. Oh, is that a joke? Jeez. Anyway, GRWG, both my puts are in the money, but I still have $2 in premium, so my downside protection doesn't kick. My break even is at $42.50. We're still $2.12 or whatever above that. Not even. We're $1.50 above that. So we got some downside protection. Like I said, it's a good company. Had a great debt ratio. I don't mind owning the shares. In fact, I'm tempted to sell another put now. Talking myself into it. Helion. I get my 850 call for 400 shares is going to get taken away. I can finally get out of this dumpster fire of a company. Guys, I'm not perfect, okay? Anybody says they're perfect, live streaming is full of crap. Helion, INO, and Kodak have been mistakes. But you know what? It doesn't matter because I took my account from 25,000 to about 43,000 over the last year. The gains make up the mistakes. All right, my other in the money, okay, that's for the covered call. Don't care about that one. That's a covered call. Don't care about that one. Anything you see orange here was me experimenting with long-dated covered calls, leap covered calls. So I don't care if those are in the money. They're in the money because of the big bull run on COVID. Post-COVID, I should say. Space down another 22 cents. I still have that $26 put in the money that I'm going to let expire and get it signed in 7 days. It's okay. I got $1.34. I also had other puts going, and that put was in play before Richard Branson tanked the company by selling his shares. That's what happened there, in case you're watching. Meanwhile, I got the 18, the 20, and the $21 puts still going through just fine. 21 might get a little close. Yeah, we got a lot of time on that one left. And then we have a $60 call that I bought when it was trading about $40, $50 a share, but that's good for another 266 days. I think what I did on that one is I sold shares while it was high and then used the money from the shares that I sold to buy a longer dated call, thus freeing up capital. Pretty sure that's what I did there. Tesla down another $4 today. Tesla just keeps kicking me in the nuts. Which reminds me, I got to open up a covered call on Tesla. Hey, you guys, let me know how we're doing in the chat room. Let me know if there's any trades you're looking at or trades you want me to look at while I do something off screen. And enjoy the music. Actually, I'm gonna look it up on this one. I hate all other trading programs for looking at puts and covered calls. So let's go 28 days out is 59%. We're gonna get tighter puts on that. If I went to 820, I'd get $241. It doesn't even buy another share. If I want to buy another share, I'd have to be at the 765. Probability of profits 84%. Gives me nearly $100 appreciation and $710 in premium. $10,000 appreciation, $700 in premium. All right, if I want to make $10, I got to come out to $745, $75, $70 above where we're at. So that's $7,000 in appreciation plus $1,000 in premium. Puts it at 80% pop. I think that's what I'm going to do. Well, let's see what happens if I change the expirations. Wow, I'm getting another 50% in premium by going another week out. Okay, so definitely should do that. So I'm doing the 28 Tesla 745 covered call. Well, if you own Tesla shares like I do, I just sold a covered call. I already own the shares. Got to try and stem the bleeding here. Thank you, Mr. Guy. We'll check out PFE. Pfizer. Ex-dividend date is May 5th. You'd have to sell the put expiring today to make sure that you have the shares before May 5th. You could also just buy the shares and sell a covered call. I guess that's what you do when you don't have any time premium for selling the put. Dividends, $1.56, 4% per year, 1% per quarter. Earnings come out 2 days before dividends. Dividend here says $1.53. The other one, $1.56. Pretty similar. Trading at 38.76. Nice affordable stock. Makes $600 million a quarter. Well, last quarter. All previous other quarters was $3 billion, $3 billion, $2 billion, $600. If they don't have another big quarter, they could have a big downtrend in the price. Maybe. Debt ratio looks like it's about 40%. Let's check it out. 63, 154. Yep, 40%, 41%. I was so much on the money. Tons of cash on hand. Almost $2 billion. Market cap of $215 billion. That's billion with a B. That stock chart is crazy. Oh, it just looks crazy. The values aren't actually that high. It's just zoomed in. 32 to 37. It's actually a pretty tight range. If you look at the 3-year, it's trending down a little bit. All right, yeah, if you guys are interested in the triple income strategy, you'd have to skip it. Hey, you'd have to skip the first step, so it would be double income strategy. You could buy 100 shares now, turn around and sell. Here, I'll help you out in case you're interested. PFE. I don't think I'll do this, but if somebody else wanted to, we look at the implied volatility. You got pretty good at 35 and 42. Let's go 42 since it's just higher. It's even higher. You could turn around and sell the covered calls. Not much. Always seems like not much to me. But if you're doing triple income, you're probably just trying to squeak out 25% a year, which is nothing wrong with that. There's nothing wrong with 25% a year gains. All right, so you get 82 at the 39. Actually, you have to do it, sorry, with covered calls, you do it at your cost basis, not at your strike. It's different than doing puts. So if you were to buy the shares and immediately sell the covered call at the money, which I'm not recommending, I'm just saying, you get 2.11% there, plus you'd get 1% on the dividends, so you're at 3%, but you have no upside and no appreciation on the stock if you do it at the money. And it's just, oh, these bid-asks are crazy spreads once you get out of the money on this. That is wicked. Oh, because there's zero open interest on this date. That's why the implied volatility is so whack. All right, that's closer to reality. Okay. So if you were to sell, for example, you could sell the 41 35 days out. You could get, probably between that, you could probably get 25 cents. You'd be buying shares at 38.84. You get 60 basis points, but you get yourself $2 of upside. I don't know how you do this one. Maybe you just sell it at the money. You don't care if the shares get taken away. I'd probably just do it at the money. I was trying to get some appreciation in there, but it's just not happening. Turn around and sell either at the money at the 39.50, collect your dividends, collect some premium, and then move on. TWTR at the new price. Yeah, we had a bit of a pullback, popped up to 77, then did a bounce at 60, what is this, 62, popped at 70, everyone took their profits back. Everyone that wanted to get out got out again at 50, now it's at 56. So is it going to continue down, or is this the new uptrend at this point? $1.70 at the 55 at the money. You get 3% at the money. Oh, it's an earnings crash today. Okay, I was looking for the earnings line on my Tastyworks, but it's because we already passed it. Oh, I'm starting to feel a bit tired, guys. It's 9:55 p.m. If you're still with us, make sure you hit that like, subscribe, and definitely tell your friends about the channel. It takes a lot of energy to do this, and I do it for you guys. I want to make you rich while I get rich. We'll be rich together. You guys can come chill with me in Bali. That's not a joke. Let's share a coconut on the beach. I do it every day, and you should too. Get out of the rat race. Get out of your mess wherever it is. Spend every day on the beach, swimming, drinking coconuts, drinking alcohol, and getting richer and richer. That's what I and God intended for you. No offense if you're actually of a different religion, okay? There's no reason for you to live in poverty, then there's no reason for you to work extra hard. If you're smart enough to do what I'm doing or to follow me, you can grow your wealth. And you can live cheaper. Did I mention that? Living in Bali is definitely, way cheaper than living in New York, California, San Francisco, Seattle. There's no riots. There's no race riots. There's no burning of buildings. There's no assaulting cops here. At least not on a massive scale. Okay, get out of the mess. Get out of the crap. Get out of the socialist crap that's going on in America. And enjoy life on the beach every day with a coconut. Cheaper. Cheaper than living in Florida. I lived in Florida. It's cheaper to live in Bali. Can you believe it? I have a beautiful 2-bedroom villa with a pool overlooking a rice field for the same rent that I paid for an apartment in Las Vegas. Okay? Which I had a pool, but it was a community pool, not a private pool. Apps got filled. I did a buy to close on apps, guys. Okay, so you guys are following this trade that I did previously. Oh, I forgot to check that. The price might be moving up. Anyway. Hey, PPS. What happened with apps today? Apps went up $3. That's why my fill went in. Was otherwise going to expire in 21 days. Hey, that's 21 days early. What did we do on apps? Hey, PPS. We sold it for $2.90. We got 30 cents above our credit. That's why I love Tastyworks instead of IBKR. IBKR screws you on fill rate, and Robinhood does too. Please get up. By the way, if you're on Robinhood, please, gosh, get off of Robinhood. They sell your order flow. They're the first one to lock down shares so they can manipulate the price so that the hedge funds and all these other capital companies can get out first. Please use my Tastywork referral link below and get on Tastyworks and like an adult and get off of Robinhood. You silly FinTalk himbo bimbos, 19-year-old traders, get off of Robinhood, please. I don't care how cool it looks on your phone, it's crap. All right, so for those that were following, we sold apps for $2.90 and then we bought it back for $1.45, 21 days early. 21 days early, guys. That's insane, that's awesome. Okay. We held this for 11 days to get 50% of our max profit. 50% of our max profit in 11 days. Fantastic. Love it. All right, guys. 2 minutes. If you haven't already, again, I say hit like and subscribe, but also read our description. We've got cool sites that you should check out. Let's see if I can pull it up here. We've got tip jars, in case you guys are interested in tipping us, if you make money. In case you followed me on apps, you just made money. Chester Wilson says, my $65 put on WDC gapped up. I'm assuming that's a good thing. Too tired for me to figure out. Bop, 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 bop. By the way, if you didn't see the video yesterday, I did a video on Virgin Galactic, how to get free shares, and why I think it could be a moon stock goes to the moon. Okay? And if you guys come down here and you click show more in the description, you'll see. Oh, I forgot to give out Discord invites. We'll do that. You'll see that we've got a tip jar down here. You guys can send me money through PayPal, Bitcoin, Ethereum, Bitcoin Cash. If you're making money, if you really like this channel, go ahead and do that. You can also join our community. We have a MailChimp sign up thing here. I don't think anyone's been using that. And if you don't have Tastyworks for some reason, you're still trading on Robinhood like a little child, be sure to click on this, my referral link for Tastyworks. I get a free iPad for everyone that signs up. Nah, I'm kidding. I have to do a bunch. I have to get like 50 or 200 signups to get some free Apple products. But I think you get $75 worth of free shares or a couple free shares. I'm not sure. They keep changing their promo. But click that referral link. You'll get whatever the promo is. I'll get some money. It'll be good for everyone involved. Right? This is a capitalist business and a capitalist channel. That means that we share the wealth with each other by helping each other. That's what capitalism is really about. It's about providing services to other people in exchange for the valuation of favors. Past, future, and present, past, and future favors is called money. It's the original distributed ledger technology before Bitcoin. It's money. You're exchanging favors as a society. That's what makes capitalism beautiful. Okay. Anyway, guys, I'm going to sign out. It's 10:01. I hope you guys have a wonderful day trading. If you didn't hear it before, I talked about a couple stocks that I might have opened if I didn't already have positions open and I was feeling okay with. My buying power is getting down there, so I'm happy to not open positions right now. But GRWG and SPCE are positions I might open. You might open apps now that we just closed out apps. If you're following me, we closed it early. Thank you guys so much. Hey Guy, thank you. I appreciate you being on the channel. I love your put spreads. You're really talking me into it. I'm gonna consider doing some of these, especially that one that you just set up that was so far out of the money but making good money. And I love that you're showing me this and that we're all benefiting. You know, as I teach you guys, I learn from you guys, but also other people on the channel get to learn from each other. So let's keep this going. Let's make sure we share the channel with our friends. Send it through DMs, put it on Reddit, do other things. If I do it on Facebook, sometimes I get banned from a group, you know. Don't get banned sharing my stuff, but you know, try and share it someplace that I wouldn't think about. That's the best way you can help the channel because we are still super new. We need that shares. Thank you guys. Have a wonderful day. Good luck trading. I will see you on Monday 8:30 a.m. Bye.